Ever get that sinking feeling at the checkout counter? That feeling that your hard-earned money just doesn't stretch as far as it did last year, or even last month. You're not imagining it. This is inflation, a silent, invisible force that constantly works to shrink the value of your money. It's the reason a $100 bill today buys less than it did a decade ago. But this isn't just an abstract economic headline, it's a daily reality that impacts your grocery bill, your gas tank, and your future plans. Stick around, because we're going to demystify the two most powerful forces shaping your financial life: inflation and interest rates. More importantly, we'll equip you with a clear, actionable playbook to not just survive, but thrive in any economic climate. So let's break this down. At its core, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Think of it in two ways. First, there's demand-pull inflation. This happens when there's too much money chasing too few goods, like when everyone wants the hot new gaming console and prices skyrocket. Then there's cost-push inflation, where the cost to produce goods goes up. Say, if the price of flour doubles, the price of your morning bagel is sure to follow. On the other side of the economic seesaw, we have interest rates. Simply put, this is the price of money. When you borrow, it's the cost you pay. When you save, it's the reward you earn. These two forces are locked in a delicate dance, choreographed by central banks like the Federal Reserve. The impact of inflation isn't theoretical, it's felt every single day. When inflation is running high, the cost of everything essential, from the food on your table and the fuel in your car to the rent or mortgage for your home, creeps relentlessly upward. Your paycheck might stay the same, but its power diminishes. Imagine your income is a bucket. Each month, inflation pokes a few more tiny holes in the bottom. At first, you might not notice the leaks, but over time, you realize you're working just as hard, yet the bucket is emptying faster and faster. This is especially tough for those on a fixed income, like retirees, who see their carefully planned savings eroded by rising costs they can't control. Here's a simple way to visualize the relationship. Picture the economy as a large pot of soup simmering on a stove. Inflation is the heat. A little bit of heat is good. It means the economy is cooking and growing. But if the heat gets too high, the soup starts to boil over, creating a mess of unstable, rapidly rising prices. The stove knob is the interest rate, controlled by the central bank. To stop the soup from boiling over, they turn the knob down, that is, they raise interest rates. This makes borrowing more expensive, which cools down spending and allows the soup to return to a gentle simmer. If the economy is too cool and the soup is barely warm, they can turn the knob up by lowering rates, encouraging borrowing and spending to get things cooking again. So how does the central bank, like the US Federal Reserve, actually turn that knob? They primarily adjust what's called the federal funds rate, the interest rate at which banks lend to each other overnight. This might seem distant from your life, but it creates a powerful ripple effect. When that rate goes up, it becomes more expensive for your bank to borrow money. They, in turn, pass that cost on to you. Suddenly, the interest rate on your new mortgage, your next car loan, and your credit card balance all tick upward. This is by design. By making borrowing more expensive, the Fed discourages large purchases and business investments, effectively pumping the brakes on the economy to slow down spending and give prices a chance to stabilize. The ultimate goal is a soft landing, taming inflation without sending the economy into a nosedive recession. First, you must become the master of your cash flow. This goes beyond just glancing at your bank statement. It means actively tracking your spending and creating a forward-looking budget. A great starting point is the 50-30-20 rule. 50% of your income for needs, 30% for wants, and 20% for savings. During high inflation, you may need to adjust these, perhaps shifting more to the needs category. Conduct an inflation audit on your expenses. Are your streaming subscriptions creeping up? Can you negotiate a better rate on your internet or phone bill? Use apps to find coupons and cashback on essentials like groceries. Every dollar you consciously decide not to spend on a low-priority item is a dollar you reclaim from inflation's grasp. In a high-interest rate environment, variable rate debt, especially on credit cards, is like a financial anchor dragging you down. As the central bank raises rates, the interest on your credit card balance can climb right along with it, making your debt more expensive each month. It's a moving target that works against you. Consider a $5,000 balance. The difference between an 18% and a 24% APR can mean hundreds, even thousands of extra dollars paid in interest. Your strategy should be to attack this debt aggressively. Two popular methods are the debt snowball, where you pay off the smallest debts first for psychological wins, and the debt avalanche, where you target the highest interest debt first to save the most money. In this climate, the avalanche method is your most powerful financial weapon. Saving cash is for safety, but investing is for growth. To truly beat inflation over the long term, your money needs to be working for you in assets that can outpace rising prices. Holding too much cash is like being on a treadmill that's slowly moving backward. So where should you look? A diversified portfolio is key. This can include stocks, particularly in companies with strong pricing power, meaning they can pass increased costs to customers without losing business. Real estate can also be a powerful hedge, as property values and rental income often rise with inflation. Assets like Treasury inflation-protected securities or TIPS are specifically designed to protect against inflation. The goal isn't to time the market, but to own a piece of the growing economy, ensuring your wealth grows faster than it can be eroded. Your emergency fund is your financial firewall. It protects you from unexpected life events, a job loss, a medical bill, a car repair, forcing you into high-interest debt when borrowing costs are at their peak. The standard advice is to have 3 to 6 months' worth of essential living expenses saved. In an uncertain economic environment with rising rates, aiming for the higher end of that range provides a much stronger safety net. But don't just let this cash sit in a standard checking account where it's losing purchasing power daily. Park it in a high-yield savings account. While it won't beat inflation, the higher interest rate will significantly soften the blow, keeping your emergency money both safe and accessible while it works a little harder for you. While defense, budgeting and saving is crucial, the best long-term strategy is to play offense. Your single greatest asset is your ability to earn an income. Focus on increasing it. This is the time to build your case for a raise at work, armed with data on your accomplishments and the rising cost of living. Look into acquiring new in-demand skills through online courses or certifications that can lead to a higher-paying role or even a career change. Consider starting a side hustle that aligns with your skills and passions. Whether it's freelance writing, graphic design, or consulting, creating an additional stream of income provides a powerful buffer against rising costs. When your income grows faster than inflation, you're not just keeping up, you're getting ahead. Understanding the dynamic between inflation and interest rates isn't about predicting the future, it's about preparing for it. The golden rule is to focus relentlessly on what you can control: your spending habits, your debt levels, your investment strategy, and your earning potential. These economic forces may feel massive and impersonal, but the small, consistent actions you take every day are what build true financial resilience. Inflation is a persistent headwind, but with knowledge as your map and a smart strategy as your compass, you have the power to navigate through it and build a secure, prosperous future. If you found this breakdown helpful, empower your friends and family by sharing it. And for more deep dives into mastering your money, be sure to like this video and subscribe to the channel.